John, maybe I'm going to start with you for the state of play, if you will. I kind of mentioned a little bit in the opening intro about kind of where we're at right now. We're still at or near record highs. The pullback happened on Friday. This is at least a rally that has been hated by so many folks out there, but it just keeps going higher and higher. So how exactly, as a portfolio manager like yourself, deal with some of the valuation concerns we're seeing?
Yeah, to your point, the market's been climbing a wall of worry now for quite some time. I think, the pundits have been calling for a sell-off for, feels like years. And, it seems like we don't get that. April was a bit of an exception, but buy the dip worked then too. And so when you think about, how to manage risk and how to time the market, that's really difficult. We really can't predict when the next sell-off is going to be, but we can prepare for it. So there are various ways that you can bolster your portfolio, make it more resilient against an equity market sell-off. And I mentioned this earlier, the reason that's so important is that so much of household wealth is now tied to stocks. And when we have a situation like that, combined with the market concentration that you see in US equities, just a few companies, the Mag 7, of course, driving markets higher, a lot of us are really dependent on just those few names, continuing to grind higher. And so you can diversify with assets like bonds or commodities, and we're going to talk about that a little bit today. But also you can turn to option-based strategies that have more structural protection embedded in them. So, options are not reliant on the correlations of stocks with another asset class. They can have a more reliable form of downside protection and also can offer income that's not interest rate sensitive, which, as we're getting into a rate cutting cycle, adding income without reliance on the Fed is becoming more and more important. I think that's driving some growth in the space.
John, as we talk about the current state of play with regard to these markets, the fact that we have some near and very near-term volatility has driven up volatility aspects of the market, especially in the option and derivative side of things, to certain higher levels than we've seen. But when you're talking about options-based strategies that kind of sell these types of instruments to help generate income, you're doing so in this environment at relatively depressed levels compared to what the historical average has been for volatility in the marketplace over the last, say, 3-5 years. As a portfolio manager who employs options, how do you find the relative value of options that you are trying to sell to generate income? And how do you reconcile that with the types of returns that we're seeing on a capital appreciation basis with the underlying assets in your portfolios?
I'd start by saying that option markets are highly efficient, just like stock markets. And so looking at just the level of volatility on the surface isn't really enough to be able to determine whether or not it's an attractive environment. In other words, when volatility is low, it's not so easy to just say, I'm going to buy it at low prices and expect to earn positive returns. Same thing with when volatility is really high. It's not as simple as to just say, I'm going to sell options because volatility looks high. Again, the markets are too efficient to make that easy to make money just based on that observation. So our view is that you need to start with some really important design principles to be able to weather all different kinds of volatility environments. Number one, and this is probably the most important, we don't use leverage. When you combine option selling with leverage, that's when you get into trouble. In our case, we build everything up front to be fully covered, fully collateralized, so they can weather any type of market drawdown and still have a great chance of outperforming the underlying equity market. A second thing I'd point to is diversifying the option overlay. So we think laddering is really important. And what I mean by that is we'll use 1 month options, but we're trading a small slice each day with a new one month option. So today we'll maybe be targeting November 13th, tomorrow to be November 14th, et cetera. Slice it up so that you get maybe 20 bites at the apple every month. That allows you to adapt. So now you're not beholden to just one price of options to overlay on the portfolio. You're moving strike prices, you're diversifying expiration dates, removing path dependency as much as you can. I think those are key elements to building something that's robust and can live through a lot of different environments.
You had both kind of mentioned a little bit about the allocation side of things, maybe how under or overexposed people are to relative parts of the market. I'd like to go back to you, John, with regard to the options overlays that go into some of your strategies. and some of the types of funds that you manage with regard to income orientations or defined outcomes, so-called buffer type funds. How much do you think a relative underexposure to some of those asset classes and strategies are to perhaps what we could see in terms of flows into some of those types of strategies going forward? In other words, is there perhaps a secular, maybe even demographic tailwind towards things like option strategies and defined outcome strategies?
I think there's a very large tailwind that could last many years ahead. And the reason is because the demand themes of income and defense against equity drawdowns should never go out of style. Those are things that every portfolio likely needs at some point throughout someone's life. They might want to reduce risk to equities. They also might want to add income that's a diversifying source, and again, not relying on interest rates. And so when we built our income advantage suite, QQA, RSPA, EFAA, tied to big, broad markets like the NASDAQ 100, S&P 500 equal weight, and MSCI EFA, the reason that these are gaining so much traction, and we're talking to a lot of clients who say it's really one of two things. They've already been exposed to this massive rally that we've seen over the last few years, and they're starting to get concerned about maybe valuations being near all-time highs, market concentration. They want to take some chips off the table. They want to downshift that risk. And then there's another camp, and these are investors that have excess cash. You know, there's been a lot of press about the $7.5 trillion in money market fund assets. I'm not sure all of that goes into equities, but there are a lot of people on the sidelines. And so when you look across the equity markets today, it doesn't feel great to a lot of people to just jump in with both feet. So our option income strategies, the Income Advantage Suite and others, offer you a way to have kind of an intermediate step in. You get a foothold, you can participate in the equity markets, but you're doing so with less risk and with again, that addition of monthly income. And so I think that's really going to be the driver of the demand, and we do expect to see a lot of growth in these types of strategies.
John, let's now turn our conversation towards a little bit more about what we are seeing in the overall markets and just how much we can see perhaps at least a transparent path forward and for how long. We know that the global trade issue is still kind of now back on the middle to front burner, given what happened this past weekend. We do know that valuations are a concern, but the AI trade has gained a lot more traction. From a risk manager's standpoint, do you feel comfortable with the visibility that you have in the markets going forward, or are you more active than you have been in, say, the last 6 to 12 months with regard to trading around, hedging, or risk managing those positions? Or do you feel as though this is one where you can kind of let things ride a little bit longer before you have to start getting really active?
I go back to, how difficult timing is. And so, our philosophy and our team is really not to predict, but try to prepare. And that just means that, we don't know when the market sell-off might happen. We do know that the market does give you different opportunities to manage risk. And today, with the level of volatility actually fairly subdued relative to history, and I would say implied correlation is another thing to keep an eye on. In other words, the way that stocks are moving within the index, they're zigging and zagging, which is suppressing the level of volatility. That's giving us an opportunity to be, leaning into hedges, to be reducing risk to broad markets. And when they do get choppy, like they did on Friday, we're there. We're prepared. We are reducing risk, at least in a portion of our client portfolios. And I think, again, that protection is getting more valuable because so many people are exposed to just this small segment of the broader U.S. equity markets. And there's a lot of complacency out there. There's still, risk taking is alive and well. So that really gives us and our clients an opportunity to say, wait a minute, I don't want to be only invested and only exposed to a broad market sell-off. How do I de-risk? How do I take chips off the table? That can happen with hedging with options, also with adding income with options. And then, of course, there are other diversifying tools out there, like Steve just mentioned, with gold and precious metals and, fixed income and other things. But these are all tools that we're using and that we think our clients, it would be probably a good idea to reduce some of that U.S.-centric equity risk because it's certainly out there, and with valuations and other uncertainty, you mentioned tariffs, et cetera, the time is very ripe to try to take some of those chips off the table.
Final question to each of you guys with regard to the kind of macro environment that we're seeing right now. John, to you first. Do you feel as though there's something that could really come home to roost in terms of risk over the next 6 to 12 months that we are not really seeing or paying attention to as much right now? We've mentioned the lofty valuations. We've mentioned some of the risks. But is there anything that you think would be keeping you up at night with regard to what could happen in the coming quarters?
I think if the labor market slows enough and consumer confidence starts to fall, what could become an issue is the interplay between people being invested in stocks and the economy itself. Normally the stock market doesn't drive the economy; it's the other way around. But given that sentiment is so tied to the direction of equity markets, that could become a self-fulfilling cycle that we, are definitely keeping our eye on. That sentiment from the retail investment community could actually impact the real economy.